There's lots of opportunities out there, and probably it's never been as exciting to be an international investor as it is right now.
Artisan International Fund's award-winning portfolio manager Mark Yockey is on Consuelo Mack WealthTRACK.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to WealthTRACK. I'm Consuelo Mack. This week we are delighted to welcome back an award-winning global investor for the second of a two-part interview. He is Mark Yockey, founding partner of Artisan Partners Global Equity Team and a longtime portfolio manager of the flagship Artisan International Fund. The fund has a 5-star bronze medalist rating from Morningstar, which named him the International Stock Fund Manager of the Year in 1998 and a finalist in 2012. Yockey and his team also oversee the Artisan Global Equity Fund, which he launched in 2010 to include U.S. investments. In our last conversation, Yockey discussed the current global investment climate and why overseas markets are outperforming the U.S. for the first time in well over a decade. You can watch it on our website, wealthtrack.com. This week, our focus is a much bigger picture, how the markets and investing have changed over the 30 years he has been running Artisan International Fund and what it now takes to be a successful global investor. First question, what are the most significant changes that have occurred in global markets?
My thoughts, Consuelo, are that the companies are a lot better managed than they used to be, and particularly in Europe and also to a certain extent in Asia. The managements are terrific. They're much more focused on profitability. It's much less about political influence. So as an international investor, that's made it a lot more fun than it was 20 years ago. Because frankly, there weren't very many growth stocks 25 years ago. And now there are lots of growth stocks. The European companies have become global in nature. They used to be very parochial, very focused on their own domestic market, very political. And now they're competing on a global basis. They're hiring Americans, they're hiring people from all over the world. They've expanded to all over the world. Americans have always been pretty international in how they view investing, and the Scandinavians too, because it's a trading culture in Scandinavia because they're small countries. But continental Europe used to be quite conservative, and now that's all changed. And in Asia too, I mean, the Chinese companies, the Korean companies, Southeast Asian companies, they're much better managed than they used to be.
How do you explain that? Why are they suddenly, much better managers?
I think it's because the capital markets are competitive. It used to be they were very siloed, and now capital moves around much more fluidly. And I think these companies around the world are competing for capital against U.S. companies. And so I think if they want to be competitive, they have to show profitability to be as profitable as American companies are. And so I think that's what's driving it.
It's so interesting as a growth manager that you said that there are many more growth companies than there used to be. I mean, I'm assuming that the number of companies that you can invest in, your opportunity set, has expanded dramatically.
Dramatically. The governments have sold tons of companies. There are a lot of the private companies, family-owned companies have gone public. So, and there's new ones all the time. The Europeans have discovered a little bit of technology, not a lot, but a little bit. The Asians as well. I mean, some of these companies in Korea are terrific.
Markets have opened up as well. I mean, we just mentioned South Korea and China, for one, where you really couldn't invest in China as a foreigner 30 years ago. Are we seeing a modernization of the markets and an openness in more foreign markets than we had when you started under Artisan International Fund?
Absolutely. So yeah. Everything's changed. Singapore is it's 5 million people on a little dot in the middle of Southeast Asia, but their influence in that part of the world is significant. And so there's some interesting companies there that we look at. Malaysia has interesting things going on. We're looking at some companies there. Indonesia is 250 million people. Indonesia is kind of challenging, but there's interesting companies there. Australia, we're not there, we're not invested there, but there's a lot going on there as well. So there's lots of opportunities out there, and probably it's never been as exciting to be an international investor as it is right now.
Why aren't you invested in Australia right now?
We haven't found anything we like, but there's lots of good companies there, and we will, and we have from time to time.
How do you keep up? I mean, how can you possibly kind of vet the thousands of companies now for in their investment potential? How does that work? How have you had to change how you approach the process?
Well, we read a lot.
Yep.
I'll put a plug in for my favorite newspaper, the FT. If anybody out there is interested in international finance, they should read the FT every day. And you have to be curious, Consuelo, and it's very easy to be, if you're an American, to just think about the United States, or if you're German, just to think about Germany. But you really have to kind of broaden your vision. You have to be like a basketball player. You can't dribble with your head down. You have to dribble with your head up, and that's what we try to do.
Technology has changed dramatically too. I mean, there wasn't an iPhone 30 years ago. It's hard for somebody my son's age to understand that at one point we did not have the internet. The globalization of investing is a huge phenomenon as well, right?
You're right, and it's particularly noticeable in places like the UK and Scandinavia, but Holland, they're very big international investors. The U.S. and Canada, the Middle East has become very big international investors, and that's changed a lot.
So the technology aspect of investing, with everything really available now on the internet that you used to have to go to the SEC library to access, I mean, how has that changed your investment process?
It's made it a lot easier to do research. It's just simplified everything. But you still have to use your head, and underlying all our investments, we try to apply some common sense. It's great to have bells and whistles, and it is much easier to do research. And you can access an annual report in a minute, and before I used to have to call the company and they'd send it by snail mail, and I'd get it 2 weeks later. And now I can get it in a minute. But you still have to read the annual report and get some meaning out of it. And so that's what we try to do, is we try to be thoughtful about how we invest and do things that make sense.
There has also been a pronounced move to index investing, to passive investing, and away from active management. How has that affected your business?
Well, it's terrible for us, actually.
For any active manager. For
30 years, we beat the index by about 350 basis points a year. So if you compound it over that, that's more than a cup of coffee. And but everybody wants alternatives and privates, and even though they don't know what they're buying, and they're sort of black boxes, they're doing it, and it's not going to change. So all we can do is try to generate returns like we are this year, and hopefully some people pay attention and let us manage some of their money.
Mark, another development has been the growth in private equity funds and hedge funds over the last 30 years. And they are now being marketed to individual investors. And whereas prior to this, they used to just be the domain of institutional investors and also high net worth individuals that were, accredited. Talk to me about your view of the growth in these, private, non-publicly traded securities.
Well, I think most retail investors don't understand these products, and even if you do this for a living and read 12 hours a day, for many of these funds, you still don't know what's in the fund. So
right.
if people are going to invest in those types of vehicles, I would just suggest to people to do it with people that have a good track record, because there's a million different funds out there, and they all want to manage your money, and there are some exceptional investors out there, but there's also some that are not as exceptional, and so people should just be aware of that.
Needless to say, I've talked to other mutual fund managers in WealthTrack's 21-year history, and I do notice that a small group of them, at any rate, a little bit more than used to be, are investing in private companies, because a lot of companies are choosing not to go public. So the opportunity set in the public market is shrinking, at least domestically it is. Is that something that you do at Artisan International? Or?
We don't do that.
You don't?
We stay with the public markets. Mm-hmm. There's plenty of stocks out there for us to work on.
We just talked about the fact that there are many more companies that you can invest in overseas than you used to be able to, when you started Artisan International Fund 30 years ago. So is the opportunity set overseas really growing?
It is.
Uh-huh.
Yeah, because a lot of these, Europe used to be very, a lot of the companies were kept by the family. And,
I see.
And there's been a turnover as the founders have aged and passed their assets on to their kids. And so that's created a lot of new opportunities for us. We invested in a private that just went public, a family company in the global fund. The stock came public at 30. They do insulation for utilities, and the stock in 3 months has gone from 30 to 60. So there are really interesting opportunities out there, and sometimes the odder they are, the better, the more successful they are, because people tend not to want to look at the kind of things that are kind of different, and we kind of like odd stories that don't quite fit in perfectly in someone's bailiwick.
What is the company? What's the name of the company that went public?
The name of the company, Consuelo, is Pfisterer, Pfisterer.
I was wondering, the fact that you have been a global investor for 30 years, that the connections that you've made and the relationships that you have over those years, how much of a difference do you think that has made for you to find out about a company?
I don't know if it's a game changer, but it's helped. The experience of having made maybe one or two or three mistakes over the years, I think has helped a lot, because you tend to not want to repeat those mistakes, and so you learn how to avoid hopefully some potholes along the way, and that's probably the best part of having a little bit of experience.
What are your biggest mistakes that you've made over the years?
Oh, golly. We were too early in the banks. The banks have been moonshots, but we were too early, the European banks, and we sold a couple that just because it was so painful holding them. When interest rates go to zero, banks don't tend to make very much money. And then when interest rates went way up, banks make a lot of money. It was so long, and it took so long, that we sold some of these things. And a couple of the names that we sold, one of the big UK banks, I mean, they all doubled or more than doubled, and that was a huge mistake.
So if you sell too early, do you ever get back in time, or?
We're buying back a stock today that we sold a long time ago, so we will buy it back. But you tend not. Psychologically, there's a little bit of a hurdle there, because you have to admit that you made a mistake, right? And as much as people say they don't mind doing it, everyone sort of bugs you, right? But we do. When you make a mistake, the best thing to do in this business, probably in everything, is admit it and move on and look and try to look at things on a clean sheet of paper.
Are there any other lessons that you've learned over the decades as far as what has helped you become a successful investor?
I think, Consuelo, investing in quality companies and really doing what we say we do, and really focusing on companies that have value-added products and services, that's where you make money on a long-term basis. And the other thing is, be willing to be different. Because if you do the same thing everybody else is going to do, you're going to get the same returns as everybody else does. And so from time to time, you have to look at things in a different way, and that's what we try to do. So
can you give me an example of how you've looked at some things in a different way?
Well, for one thing, the Greek banks. I was at a party at New Year's last year, and I was with a couple of Greeks that lived in Athens, and this is in the United States. The party. It was a New Year's party, and I suggested they invest in the banks in Greece, and they laughed as if I told a funny story. because the people hated the bank so much, and they told me I was an idiot. And you know, the Athens Alpha Bank, it's a bank in Athens, the stock was, I think, 150, and now it's 370 or something. And on top of that, they buying back stock, and they made 2 acquisitions, and they're 20% owned by Unicredito, which is an Italian bank, which is probably going to buy them. So, you know, sometimes if you tell someone a story about a stock and they laugh, then you probably should buy more.
Other ways to be different. Number one, at this point, being an active manager, not being an index hugger, that's different. And I know Morningstar, you know, one of the headlines about your investment style is, you know, not afraid to be bold. Do you see yourself that way?
We want to do our own thinking, and we're not index huggers. I think that would be very boring. We try to be creative, and we try to find innovative ideas, and we try to invest in companies where, you know, we try to get there early. Sometimes we're too early. You know, we invested in Deutsche Börse like 10 years ago, and the stock was 40 or 50 euros a share, and it's the German stock market, but they trade derivatives. No one wanted them. It was a sleepy German company. And then they brought in good management, and this fellow who was just recently retired, you know, he just dynamized the process. You know, he just brought in other people to run it more in a more efficient way, and the stock went from 50 to 270. One thing we do at Consuelo is we really look at new management. When new management comes in, that's a note to self. Really pay attention at what's going on to see what they're trying to do, because management makes a tremendous difference sometimes.
I was just going to ask you that. How important is management?
Yeah, really super important. If you can get a good business and a good management, you're going to make money. As Buffett says, you know, give me a good business and a bad management more than a bad business and a good management. But what we think is, give me a good business and a good management, and we're going to make you money.
Right. We've been, talking about the fact that that management has improved overseas, that there are many more companies that are available to invest in, and also that investing has gone global. I mean, there is a lot more competition. You are facing a lot more competition globally now than ever before. Do you find that it's more difficult because your industry is so well researched and there is so much more talent, PhDs and everything else coming into the business? Do you find that it's more difficult to have a competitive edge?
No, I don't think so. I think it's always this industry attracts smart people, as it should, and that's always been the case. And there were a bunch of smart people 30 years ago running around, and there's a bunch of smart people today running around. It doesn't matter how many letters you have after your name. People are all trying to be successful, and they're looking at the same stocks. And in that regard, nothing's changed. You
and I have been through a number of market cycles, a number of economic cycles. Where is the world now? Let's start with the U.S., but where is the U.S. as far as its economic cycle and its market cycle, do you think?
Personally, I think we're a little bit late in the cycle. And the bulls think we're early in the cycle. I think we're late in the cycle. We haven't had a recession really since 2008, really.
Right, a major one.
I mean, COVID was a one-off kind of thing. And so, at some point, recessions serve a purpose. They reset everybody's expectations, and they make people pay attention and get rid of some of the silly stuff that goes on during bull markets. I'd say we're a little bit late in the cycle here.
And what markets are early in their cycle or are earlier than the U.S. is in their cycle?
Well, China, I think China is going to have a hard time having a cycle. I think they're just going to kind of dither along, but the stock market will do well because they want it to. And they want the private sector to make money. The car sector in China is really exciting, actually. In
the car sector?
Yeah, super exciting. They have great technology in the car sector. And by not allowing EVs to develop here and taking away the subsidies, you really have to think about that pretty intensely, because the EVs are a big deal in Europe and in Asia as well. If you go to the Middle East, I don't know what percentage of the cars. I was in Dubai a while ago, I mean, it's seemingly half the cars were EVs. I'm sure
Really?
it's not true, but they're everywhere. BYD and the other Chinese car companies are everywhere, except here. And they're not going to let them in, and I get why, but the technology is important, and we're in danger of falling behind, and which I think is kind of too bad.
And so other countries have the infrastructure, the charging stations and whatnot to support
Yes.
their EVs, which
Yep.
we do not. What are the most important investment lessons that you have learned over the years?
So invest in real companies that have real products and services. Don't invest in companies you don't understand. And look at their income statement and their balance sheet to make sure they're not crooks. And if the management has a checkered history, then go somewhere else, because there's lots of good companies out there. And why invest in companies with bad management?
Your approach sounds like it's pretty diversified. Is diversification important to you as far as you're concerned?
It is.
Yeah.
But within that, when we find ideas and themes that are really powerful, we're willing to have the courage of our convictions and put significant assets in some of these companies. UBS we bought it when they merged with Credit Suisse. It's a 5% position. The Korean defense names are 4% positions. So, these are large positions for us, and so we have a lot of conviction that they'll be successful investments.
And are you, optimistic as far as the future of investing? Do you think that equity investing is a place that basically all individuals should put a large portion of their retirement plans in?
Absolutely. Investing in equities is fantastic, but you can't go down every rabbit hole every time somebody tells you about some name, and you can't just throw money at the wall. I mean, people, if they do it themselves, they should take the time to be thoughtful about it, because money is hard to make, and you don't want to lose it by buying, investing in some company that it's going to blow up. People should be thoughtful about it, because it's hard to make, but it's easy to lose. And my advice is invest in things you understand. And if you don't understand them, probably be really careful.
The one investment for a long-term diversified portfolio, what should we all own some of?
So I think the energy transition is huge, and I think National Grid is a really low-risk way to invest in the energy transition around the world, and they pay a big dividend, and it's going to grow 5 or 10% a year, so your total return is going to be double digits, and you're not paying very much for it. And it's a business that can't be disintermediated because it's a monopoly, and so I think it kind of ticks all the boxes. And if there's a recession, we haven't outlawed recessions. I'd like to, but I don't think we can. And if there's ever a recession, you're going to be really happy you own National Grid.
That's great. Mark Yockey, thank you so much for joining us once again on WealthTrack.
Thanks, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. In part one of our interview with Mark Yockey, we asked him to share the best piece of investment advice he has ever received. You can see his answer on wealthtrack.com. This week, we asked him for his advice for us to recommend one action we could take to make us better investors. This week's action point is only invest in companies you understand.
To be a good investor, I think you have to be curious and you have to do some homework. My thoughts are, if you want to do it yourself, read a lot and understand the companies you're investing in. Don't just go by what somebody told you, at the coffee machine. And if you do hear of something at the coffee machine, take the time to go on the internet and find out what the company does and see, does it make sense? And is it a product or service that is hard to replicate? Because our whole idea is, and it's worked for a long time, is you want less competition, not more competition. As a consumer, you want competition. As an investor, you don't want competition. You want monopolies or quasi-monopolies. And that's what we look for. So these are the kinds of companies that I'd suggest people look at to invest in.
Only investing in companies you understand can be applied more broadly to any investment you make and save you a lot of grief. Esoteric and derivative products like synthetic collateralized debt obligations proliferated leading up to the global financial crisis before imploding. And we are now seeing multiple offerings to individual investors of many illiquid and opaque private equity and private debt offerings that used to be only available to institutional and high net worth clients. Caveat emptor, buyer beware of products and securities that are difficult to understand. Next week, handling unexpected risks. What personal finance master Jonathan Clements did in the face of a terminal illness. If you are so inclined, please follow us on Facebook, X, and our YouTube channel. Thanks for watching. Have a superb weekend and make the week ahead a healthy, profitable, and productive one.